Hello everyone, welcome back to my YouTube channel. Today we are discussing the latest developments in the Vietnamese dong exchange rate against the US dollar, a topic that continues to draw attention from global investors, economists, and currency watchers as Vietnam's economy navigates a complex international financial landscape shaped by shifting interest rates, export dynamics, and regional currency pressures. In recent weeks, the Vietnamese dong has shown relative stability against the US dollar, but that stability comes with underlying pressures that reflect broader global economic trends. The exchange rate has remained within a controlled band, largely due to the active management by the State Bank of Vietnam, which continues to pursue a policy of gradual adjustment rather than abrupt devaluation. This strategy aims to maintain investor confidence while supporting export competitiveness, a critical pillar of Vietnam's economic growth. The US dollar itself has remained strong on the global stage, supported by higher for longer interest rate expectations in the United States. This strength has placed persistent pressure on emerging market currencies, including the Vietnamese dong. However, unlike some regional peers that have experienced sharp depreciations, the dong's movement has been relatively measured. Analysts attribute this to Vietnam's strong foreign exchange reserves, consistent trade surpluses, and a disciplined monetary policy framework. One of the key drivers behind the current exchange rate dynamics is Vietnam's export performance. The country remains heavily reliant on exports, particularly in electronics, textiles, and agricultural products. As global demand fluctuates, so too does the inflow of foreign currency. Recent data suggests that while export growth has moderated compared to previous years, it remains resilient enough to support the dong. This resilience has helped prevent significant downward pressure on the currency, even as global trade conditions remain uncertain. Foreign direct investment also plays a crucial role in supporting the Vietnamese dong. Vietnam continues to attract substantial inflows of capital, particularly from multinational corporations seeking to diversify their supply chains away from China. This trend, often referred to as China Plus One, has positioned Vietnam as a key beneficiary in the shifting global manufacturing landscape. The steady inflow of investment dollars contributes to foreign exchange liquidity, helping stabilize the currency. At the same time, policymakers in Vietnam face a delicate balancing act. On one hand, a weaker dong can boost exports by making Vietnamese goods more competitive in international markets. On the other hand, excessive depreciation can lead to imported inflation, especially in a country that relies heavily on imported raw materials and energy. The State Bank of Vietnam has therefore adopted a cautious approach, allowing for gradual depreciation while intervening when necessary to prevent volatility. Inflation remains another important factor influencing exchange rate policy. Vietnam has managed to keep inflation relatively under control compared to many other economies. But there are still concerns about rising costs, particularly in energy and food. A stable exchange rate helps mitigate these pressures by keeping import prices predictable. As a result, currency management is closely tied to the broader goal of maintaining macroeconomic stability. Global financial conditions have also played a significant role in shaping the Vietnamese dong's trajectory. As major central banks, particularly the US Federal Reserve, maintain tight monetary policies, capital flows tend to favor developed markets. This creates challenges for emerging economies like Vietnam, as capital outflows can weaken local currencies. However, Vietnam's strong economic fundamentals have helped cushion these effects, allowing the dong to avoid sharp swings. Another factor worth noting is Vietnam's growing integration into the global financial system. The country has signed multiple free trade agreements and continues to deepen its economic ties with key partners. This integration brings both opportunities and risks. While it opens up new markets and attracts investment, it also exposes the economy to external shocks. Exchange rate management becomes even more critical in this context, as it serves as a buffer against global volatility. In the domestic market, demand for US dollars has remained steady, particularly among businesses engaged in international trade. Importers require dollars to pay for goods, while exporters convert their earnings back into dong. The balance between these flows influences the exchange rate on a day-to-day basis. Recently, there has been a slight increase in demand for dollars, reflecting higher import activity as the economy continues to recover and expand. Tourism is another sector contributing to foreign currency inflows. Vietnam has seen a gradual recovery in international tourism, which brings in additional dollars and supports the local currency. While tourism levels have not yet fully returned to pre-pandemic highs, the upward trend is encouraging and provides another layer of support for the dong. Market sentiment also plays a crucial role in currency movements. Investors closely monitor economic indicators, policy decisions, and global developments to assess the outlook for the Vietnamese dong. So far, sentiment has remained relatively positive, with many analysts viewing Vietnam as one of the more stable economies in the region. This confidence helps anchor the currency and reduces the likelihood of speculative attacks. Looking ahead, the outlook for the Vietnamese dong will depend on several key factors. The direction of U.S. monetary policy will be particularly important. If the Federal Reserve begins to ease interest rates, it could reduce pressure on emerging market currencies and provide some relief for the dong. Conversely, if rates remain high for an extended period, the dollar could stay strong, continuing to exert downward pressure. Domestic economic performance will also be critical. Strong GDP growth, robust exports, and continued investment inflows will support the dong, while any signs of kamjori could lead to depreciation. The government's ability to maintain macroeconomic stability will therefore be a key determinant of exchange rate trends. Another area to watch is the level of foreign exchange reserves. Vietnam has built up a substantial reserve buffer over the years, which allows the central bank to intervene in the market when needed. These reserves act as a safety net, helping to smooth out fluctuations and maintain confidence in the currency. Maintaining and potentially increasing these reserves will be important in the months ahead. Regional dynamics cannot be ignored either. Currencies across Asia often move in tandem due to shared economic linkages and investor perceptions. If neighboring currencies weaken significantly, it could put additional pressure on the Vietnamese dong to adjust in order to remain competitive. At the same time, coordinated stability in the region can help support all currencies, including the dong. It is also important to consider the role of digital transformation and financial innovation in Vietnam's economy. As the country modernizes its financial system, including the adoption of digital payment platforms and potential exploration of central bank digital currencies, the way currency flows are managed could evolve. While these developments are still in early stages, they may have long-term implications for exchange rate dynamics. For everyday citizens and businesses, the exchange rate has practical implications. A stable dong helps keep prices predictable and supports purchasing power, while fluctuations can affect everything from import costs to travel expenses. Businesses engaged in international trade must carefully manage currency risk, often using hedging strategies to protect against adverse movements. In conclusion, the Vietnamese dong's exchange rate against the US dollar remains a reflection of both domestic strength and global challenges. While pressures from a strong dollar and uncertain global conditions persist, Vietnam's solid economic fundamentals, prudent policy management, and steady inflows of foreign capital have helped maintain relative stability. As the global economic environment continues to evolve, the Vietnamese dong will remain a key indicator of the country's economic health and resilience.